Hi, welcome to Bond Bytes, the daily bond market highlight from INR bonds. I'm Arjun Patsarthi. And the Fed has hike rates in its policy meet yesterday, which is the 3rd of May. And they have cited that this could be the last of the rate hikes, or there could be a pause for a while. I mean, they've not said that it could be the last. However, with the backdrop of banking system collapse in the US, there are already 4 banks that have failed, and more banks seem to be on the verge of failing as well, largely due to many factors. But with and there is firefighting going on, and depositors are being bailed out. Bondholders are obviously getting hit very badly because banks, when they get liquidated, the bonds are getting written off. Now, this is not the great. This is a very difficult scenario, especially when banking sector when banks start to uh, have some kind of a domino effect and collapse because of lack of liquidity. Because nobody wants to, except for the big banks, nobody wants to lend to smaller banks, and this is creating a kind of a liquidity kind of an issue in the US. And the Federal Reserve has to come and do something to stem this rot. But more importantly, what is the effect of this on the markets, especially the bond markets, and especially bond markets in India? In the US, after the rate hike, the US 10-year Treasury yield traded at 3.33% levels, which is down from those 4% kind of a levels. And in today's Indian bond market, the 10-year gsec yield went below 7%, which is again multi-month low. And the 5-year gsec 2 is at 6.96% and 92%. And in today's gsec auction, the 10-year gsec yield cutoff came at 7.43%. So what is the Fed rate hike and the US bank collapse impact on Indian bond markets? For in terms of GSEC markets, clearly the markets are saying that RBI could extend its pause that it did in April, so which is positive. Hence, and also with good government finances looking up with very strong GST collections in March, and the the rupee is also stabilizing. All this put together is helping the GSEC yield come down. The 10-year GSEC yield, as I said, is trading at close to 7% and is down and is at a multi-month low. Whether it can, but having said that, the RBI is not likely to lower rates, and is likely to be very cautious, especially in terms of they'll be tightening their grip on banking sector and on the NBFC market. And this could actually uh, uh, make short end rates still high. So if you look at the short end in the if you look at the 1 to 10-year kind of maturity in GSEX, the 1, 3, 5, 10 and all are trading in a 670 to 7% kind of a band. And in corporate bonds, AAA corporate bonds too, they're trading in something of a similar kind at higher levels. So what so one is on the positive side, Indian banks are definitely, especially the larger banks and larger NBFCs, are definitely seen as a much better kind of regulated entities and more stable because RBI has been monitoring very closely. Hence, a lot of money could actually come into the Indian bond market where they move out of perceived riskiness in global bonds and come to more stable kind of bond market. On the negative side, the liquidity, there could be risk aversion, and this could have this could have a domino effect on the market, and this could mean that capital goes into U.S. Treasuries and very safe assets, and that help and that yeah, it reduces the money in the economy And this could hurt smaller lenders, lower rated borrowers, and many others. And that could make cost of funds very difficult. So the couple of observations on the impact of the collapse of the US banking system. One is that government bond yields have trended down in India, but corporate bond yields have not trended down so much. So clearly markets are diverging between the riskiness of the each bond. So government bond yields are the there is no risk in credit risk in government bond yields, whereas in corporate bonds there is credit risk, and that is telling. So corporate bond yields largely have been very stable, except for the PSU bonds, Bharat Bond ETF, and some AAA bonds. But otherwise, they've all been trading where they were pre-pause, pre-RBI pause. And high yield bonds are still finding it very difficult in the market to raise funds, and they're trading at very high yields. So there's a market where investors have to pick and choose the right bonds, and potentially with a pause and by the RBI and stronger positive flows. The Sensex and Nifty are trading at close to record highs. The rupee is strengthened from lows, and all this maybe and some of the initial corporate results in a few sectors are very decent, except maybe the export IT sector. But except that there is definitely better conditions in the market at this point of time, and that is also could help the bond market stabilize, and especially the corporate bond market could see some better traction going forward. But there could be a clear demarcation of risk by investors, and they could turn to safer bonds or very selective on which bonds they are looking to invest in. So that's about it for now. And if you're a financial advisor, obviously the best place for you to look at bonds, get information, prices, and also select the best bonds for your clients to invest in to give you the best returns on a risk-adjusted basis. INR Bonds Partner Portal gives you all the support that financial advisors need for transacting for the investing and transacting for the clients and maintaining their portfolios. So log into INR Bonds and see your fixed income assets grow. And download our app, Quick Invest by INR Bonds, for the best curated list of bonds on offer from a 300 plus bonds offered on a daily basis. INR Bonds, with its quantitative and models, have shortlisted a curation of bonds, giving you the best risk-adjusted return score for each bond, which makes it much simpler for an investor or a financial advisor to select bonds and invest. Thank you very much for listening in, and do follow us on our YouTube channel.